Hey there, welcome to the Covering Crypto live stream. I'm Jim Armstrong with Fidelity. It is our annual taxes episode, and there's always something new to talk about in terms of tax regulations and changes. Even crypto veterans still get tripped up over reporting and trying to get everything right. So today we're going to give you an overview and answer as many of your questions as we can, but it is important to note that today's conversation will not be giving tax advice. Fidelity doesn't offer tax advice. We always do suggest that you reach out to a licensed professional or someone in your life, a CPA, a tax attorney, someone who can speak to your specific situation. To bring us through what we know about crypto and what you should know about crypto taxes generally for 2026, we're thrilled to have Michelle Dunning on the show. You are unfamiliar to any viewers of the live stream, but to us behind the scenes, you are instrumental in helping us every year put together this episode. So this year we figured rather than have you be behind the scenes, we'd have you in front of the camera. So thanks for saying yes.
Yeah, thank you for inviting me. Just to introduce myself, Michelle Dunning. I lead the tax department for the crypto assets at Fidelity, so the digital asset space. My team is responsible for making sure that we get those tax forms out to our customers and the reportable agencies they need to go to.
All right, we've got a lot to cover today. In about 45 minutes or so, we're going to hit on a lot of topics, and we'll talk about an overview of how crypto is taxed. We'll talk about some changes that you should know about for 2026. We'll also cover the different tax implications for things like income, staking, or gifting crypto. Michelle will also walk us through some tax forms and also cover some tax-related strategies that might help you out this year. We're going to start right now with a couple of questions that came in during registration at a very high level. Questions about how crypto is being taxed. That one came in from Jasmine, and what the tax implications are for owning crypto. We get that question a lot, Michelle, about whether or not cryptocurrencies are potentially taxed. And the answer is absolutely yes. They are subject to taxes. You can actually learn a few basic rules about how crypto is taxed in an infographic that we've put up on fidelity.com/crypto taxes explained. You can check that out to learn more. But Michelle, at a high level, how is crypto taxed?
So the IRS treats crypto a lot like they treat securities. They are seen as...
Well, they're not seen as currencies, right?
They're not
that's
currencies,
they're cryptocurrencies,
correct.
but the IRS doesn't treat them as
They're
currency.
property, right? They're property. So when you buy or sell, you buy, you're building a basis. When you sell, you're going to have either a gain or loss from that basis. So that is what you're going to be taxed on from the IRS purposes.
And now Janet's question was specifically about owning crypto. And so there are plenty of people watching for whom crypto is a long-term investment. Maybe they're buying and buying over the course of the year, but not selling. What's the tax obligation if I'm just a holder?
Yeah, just a holder, you're not going to have a tax obligation. You're not going to see it until you actually dispose of it some way. You sell it, you use it to pay for something. Once you get rid of it, that's where your tax implication comes in.
But no matter how much you bought during the course of a year, no matter how much it fluctuated in value during the course of a year, if you're just holding?
Just holding, no taxes.
Kind of a similar question that came in during registration from a viewer named Dave, who wants to know if there are tax implications of holding crypto within a crypto account, but not moving those funds back to my investment account. So from what we just talked about in terms of holding, to reiterate, it sounds like Dave falls into that category of people. Maybe he had some money in an investment account or a brokerage account, moved that over to a crypto account, bought some crypto, but the money is still there in that crypto investment. Sounds like no tax due, but Dave, we'll say it now and we'll probably repeat it. Always check with your tax professional for any specific questions about what your situation is. Now, we will get into details on tax reporting in a bit, but first, we did want to note a few changes for crypto taxes for the 2025-2026 tax years. This is, as we noted, an ever-evolving space with new rules and regulations just about every year. Start us off, Michelle, with the 1099-DA, where DA stands for?
Digital assets.
Digital assets. What do we need to know
this
there?
Is our new form that we are going to report all of your sales on. So as a centralized exchange custodian, we are responsible for creating this 1099-DA to tell our customers what they sold in the year with us. It will come out looking similar to a 1099-B. There's a few different boxes, but essentially it's going to report what you sold, how much you sold, and when you sold it.
And to be super clear, there are lots of digital asset custodians out there. And you just heard Michelle talk about we and us. In this case, and for this live stream, we're going to be talking about Fidelity Crypto as offered by Fidelity Digital Assets. Just remember that what Fidelity does doesn't necessarily apply to what all other digital asset brokers or custodians do. So we'll be our best to be as specific as possible. But to reiterate, you will receive a 1099 DA if you sold crypto through a digital asset custodian in the 2025 tax year. If you just held your crypto, you won't. So generally speaking, we have a visual we can pop up on the screen. What's in that 1099 DA that people might see for the first time this year?
Yeah, so just like any tax form, you're going to have your personal information. So your name, your address, your social security number, probably masked. And then you're going to have your custodian's information. So our name, our address, our tax ID number, and then specifics about your trades. So how much you sold, when you sold it, how much you received for it, the proceeds you received for it. Those are all going to be on there. As you can see, there's other boxes available, including stuff for cost basis that for 2025 tax year, we will not be sending to the IRS because we have no requirement to do that. But on your Fidelity version, you will likely see information in there just for your copy, not what we send to the IRS.
Got it. Okay. And that's a great point. I want to reiterate or talk again about one change for this current calendar year that will apply for your 2027 tax filing that you just alluded to there. So it's good to know and plan ahead about it. As of January 1st of this year, of 2026, digital assets custodians will also be required to include the cost basis for any crypto that you bought on that platform on or after January 1st of this year. And again, that's going to be reported in next year's 1099 DA, applying only to sells and buys this year. At a high level, Michelle, why is that a good thing? I mean, getting your cost basis on that 1099 DA in 2027 should help traders figure things out.
Yeah. So with what we're doing this year in 25, by not providing any information to the IRS, it's up to the customer to make sure that they're putting that on their 1040, their forms that go with it, and letting the IRS know what they paid for it. Once we are reporting the cost basis to the customer on the 1099 DA that is going to the IRS is going to know what you paid for it. So there's no question as to what your beginning is. So you really are just being taxed on what your gain is from that sale.
And that matters because without specific instructions, the IRS doesn't know what your cost basis is. And in a worst case scenario, they'll call it zero, meaning you would have a tax obligation on the entire amount.
Correct. If you're not filling that out on your 1040 with the Schedule D and the 8949 to tell them what that basis is, they don't know. So they'll assume it's nothing. And then you're going to be paying tax on that entire sale.
Which you don't want to do if possible.
No, we don't want to do.
Let's get back to some questions that came in during registration that are more connected to this year's filings. Carol, for one, wants to know if, in fact, she gets taxed on the income she earns with crypto. And then we had a couple of other questions about the tax implications of trading crypto, both in the long term and in the short term. And so, yes, Carol, you are indeed taxed on realized earnings and income. There are a couple of ways, at least a couple of ways to define income. So we'll talk about those in a moment. But high level, if you sell your crypto and earn a profit, positions held for a year or less are going to be taxed as short-term capital gains. Positions held for over a year, for more than 1 year, are taxed at lower rates. They are considered long-term capital gains. In other words, long-term cap gains rates apply once you've held the asset for 1 year and 1 day. So, Michelle, there's a handful of examples here for what the IRS might well consider to be a taxable event. So we'll run through those right now. And the first one is a good one, if you exchange one cryptocurrency for another.
Yeah. So when you're taking, let's say, BIT and going into ETH with those assets, you're still getting rid of BIT. So that is a taxable event. So whatever you paid for that Bitcoin and then later exchange that to go into the Ethereum, you're going to have a gain or a loss from what you started in the Bitcoin with to what you're actually exchanging into the Ethereum for.
And so in the example we have on the screen now, big numbers, maybe not realistic for everybody, but useful for the easy math. Let's say you bought $40,000 worth of Bitcoin and then 3 months later or so, you leave that position and exchange it for $60,000 worth of ETH. Your taxable gain is
$20,000.
All right. Now, what if you buy goods or services using crypto? This one, I think, might take some people by surprise.
Yeah, it's still a disposition of your position. So you are going to have a taxable event. You may not get tax form necessarily for doing it, but you still have to report it. And same thing, you're going to have some basis, something that you paid or you brought into income somehow for getting that position. And when you let go of it, when you use it to buy that good or service, then you're going to have a gain that you're going to want to be including on your taxes or loss, depending on what you had.
Right. We'll get to losses later because that's important to talk about. But in this specific example, let's say, again, big numbers, you have a $40,000 position in Bitcoin that you choose to, what's the right word, liquidate, you close that position.
Yeah.
When it's worth $70,000 to buy a car. Maybe you find a car dealer who will accept Bitcoin,
right.
Or you sell it to cash and you give the car dealer cash. You owe taxes on that $30,000 appreciation.
Correct.
The other thing I want to linger on here for just a second is that's a great big example where maybe you liquidate your whole account or close that position entirely. But let's say you have a $40,000 position in Bitcoin and one day last year you spent $5.75 on a cup of coffee. That's a taxable event.
It is. And that $5.75 has some basis attributable to it from that original $40,000. So you would have to figure that out and know what the difference is to be able to figure out what your gain is on that cup of coffee.
So at a or potential loss, like you said,
loss,
but at a high level, the takeaway there is any time you use crypto to make a purchase, to buy a good or to buy a service, you potentially have a tax obligation.
Absolutely.
What if I send crypto to somebody else?
So gifting, just giving it to somebody else. I want to send money to my kids.
Yep.
That is not taxable in itself, but there are rules that you'll want to talk to a tax advisor because you're only allowed to gift so much in a calendar year and you don't want to have to pay taxes because you've overdone that. But just giving it to somebody is not a taxable event for you.
Cool. All right, let's talk about making money in crypto too in the form of income, which I think is what Carol was asking about. So again, high level, yes, you are going to be taxed if you had digital assets as part of your earned income. So let's talk about some examples of that as earned income, your salary, for example.
Yeah. So just like if you're paid in US dollars, you're going to have to bring that into your income. Just because it's paid in Bitcoin does not, or any other cryptocurrency, does not stop it from being income to you. So whatever it was at the time that you were paid, that is what you're going to be bringing into your income.
And this example, we talk about maybe people in the gig economy, you do some freelance work once, and in the example we have on screen, you get paid $5,000 in Bitcoin.
Yeah. Yeah. So that $5,000 is going to come into your income just like $5,000 in cash would come into your income.
And if I don't sell that position, if I got paid, let's say in September, calendar year ends, I haven't sold it, I owe taxes on the $5,000 as income. But if that's worth $12,000, what does that mean?
Nothing until you sell it.
Okay.
Yeah. So the $5,000 is coming into your income because you earned that at that time. But the gain that you've seen because you haven't done anything with it, unrealized, it isn't taxed until you actually realize it.
Okay. How about the other set of circumstances? Maybe you received crypto through mining or staking or as part of an airdrop. And real quick, for those who might be unfamiliar with those terms, you can always head to fidelity.com/learncrypto to learn more, but we'll define them briefly here. Mining, and if you're a miner, you almost certainly know it if you've made any money from mining or earned any crypto from mining. It's basically the process of solving difficult math puzzles to help verify transactions and secure a blockchain. And miners receive new crypto in return. Staking is one that might be more familiar to people watching right now. It's a potential way for long-term crypto investors to maybe earn passive income in the crypto world. You stake a certain cryptocurrency. It sometimes is referred to as locking it up. You lose access to that crypto, and in exchange for that, you're often paid in cryptocurrency. And an airdrop is just a way for a cryptocurrency's development team to deposit a new coin or token directly into your crypto wallet, usually as some sort of marketing event. So I know there's throwing a lot at you there, Michelle, but what are the tax obligations for those types of things?
Yeah, so for the mining and the airdrops, you're probably not going to get a tax form from whoever paid those to you.
Okay.
So you'll want to make sure that you speak with your tax advisor and see if there is something you have to do on your taxes for it. The staking, you will likely get a tax form. With that tax form, you're going to want to bring it into your tax return just like you would any other tax form, account for it somehow. Whether there's actual taxes you have to pay on it will just depend, but you'll want to bring that in and obviously take those to your tax advisor too, so that they can make sure that they include it in your tax return.
And staking probably doesn't take anybody by surprise. You have to actively do some proactive steps in order to stake your cryptocurrency. And you're probably doing it because you're aware that you might receive some crypto as income for that. So you know it's going to happen.
You would hope, yes.
You would hope, right. What happens if you sold goods or services and got paid in crypto? So, the example we use here is, let's say you've got an online store, and in this example, you're selling candles. So in January, you make $45, you got paid in crypto, but over the course of the year, the money you earned in January, let's say it goes on a tear and it's worth $450. What's my taxable obligation as the person who sold a good or a service and got paid in crypto?
So just like, again, if you were getting paid in cash, when you earn that $45, you're going to bring it into income somehow.
Okay.
When you have it in crypto, it's no different. You're still getting that into your income. And that $405 gain that you're sitting on, if you haven't sold it, it's not going to do anything to you. It's when you sell it and recognize that gain that you would have to bring that $405 in as a gain from that sale.
So in that example, sort of like the person who maybe was a freelancer and got paid, the potential for two taxable events. One, when you take it into income.
Right.
And then whenever you sell it, which might be that year or might be 10 years later.
Yes. Yeah. You don't have to sell it right away unless you need to. So you're not going to recognize the growth tax event until you actually sell it.
Got it. Okay, so to put a finer point on it, gains from crypto trades and or from crypto classified as income are going to be taxed at the applicable tax rate, depending on a number of factors, including your holding period and your capital asset status. So to figure out the marginal tax rate that might apply to your specific situation, well, you could simply do an internet search for the latest tax tables, or you could head to our website, fidelity.com, and just put the words tax rate into the search bar, that kind of white bubble in the upper right-hand side of our website. Tax rate will take you to the latest tables, and that's always evolving. And it also really matters whether or not you're married or single, or married filing jointly, married filing separately, and those numbers change year to year. So worth checking out to get a better sense of what you might owe. Let's talk about crypto transfers now, Michelle. That's a relatively new feature as offered by Fidelity Digital Assets as of 2025. You can transfer cryptocurrencies into and out of your Fidelity crypto account. So we have a couple of questions for you. One came in during a live chat, and the person says, how can I transfer my crypto from another company to Fidelity without paying taxes on gains or losses? And then another question that came in, can you transfer crypto from another platform directly to a Fidelity crypto account? The answer is yes. If so, is it a taxable event when there are gains there already? That was from William. So talk about transfers, please.
Yeah, so the act of transferring is not in itself going to cause you any taxable event. Just like in the securities world, which many of our customers are already familiar with, moving from one custodian to another, not a taxable event because you're going between your own accounts.
Okay.
Even when you have large gains sitting there, it's just moving. You're carrying your basis over. Doesn't automatically carry over, but your basis is still staying with those coins. And then when you go to sell it, that's when you're going to recognize any gain that you're looking at. That
first question from live chat almost seemed like the guy was looking for a cheat code or something, like, how do I not have to pay taxes on that? But that's
not needed. It's already there.
It's already there. Very cool. I want to talk a little bit about reporting and cost basis. We've mentioned it a couple of times, but it's an area where people might get tripped up. So we can dive a bit deeper now. James wants to know, is cost basis tracked and reported by Fidelity Digital Assets? And David wants to know if there is a special form you need to fill out while doing your taxes. So we talked about the 1099-DA. We'll recap that. We'll talk about the other forms as well. But let's hit cost basis again, Michelle. What do people need to know about cost basis?
Yeah, so Fidelity is tracking your cost basis. Any buys that you purchase at Fidelity, we already have that information. We're going to keep it for you.
Okay.
If you're transferring into us, we don't know what you paid for it at the other custodian. So you will have to update the basis with us, and we will continue tracking that for you. We don't report that to the IRS. We're not required to, and we're not going to. So will show on your personal DA as information.
Okay.
We will not be sending that on to the IRS when you sell those coin that you brought in. But again, we're going to track anything that you give us. We're going to track anything you buy with us. It's already on our platform.
onus is such a big word, but like that really hasn't changed. If you're someone who is trading cryptocurrency, the burden does fall on you as the investor/trader to really keep accurate records.
Well, I mean, again, we're going to track it for you, but yes, you should definitely pay attention and make sure that what we have built is what you believe should be there as well.
What other information would you give for somebody trying to do the calculation to keep track of their gains or losses for taxes?
One, check your statements, check your accounts to make sure. There are other softwares out there that you don't have to have them, but for somebody that wants to be seeing all the time.
Yeah.
And then like just pay attention to what you're doing in your account to know, am I building my basis? Am I reducing my basis because I'm taking something out of my account? So watching those things.
And the idea too, like you said, when you transfer, if you transfer into Fidelity Crypto, for example, you report your cost basis, get it written down so that there's no confusion, and do it while it's fresh in your mind.
Yeah, you absolutely. Fidelity.com is very easy for them to go in and input their basis from those transfers.
Okay.
So they would just go in and record that themselves, and then we will continue tracking it, and you'll be able to see it on your Fidelity.com application as you're going in and looking at it.
Cool. I want to summarize some other forms in general to that other question that came in, forms that you may need to report cryptocurrency transactions, and we'll put them up on your screen as well. You will report any capital gains on your Schedule D. That's Form 1040. However, it's likely that you're going to need to complete Form 8949 first in order to complete Schedule D accurately. Gains from crypto classified as income are going to be reported on Schedule C and Schedule SE if you receive them as a self-employed entity, that freelancer example that we gave earlier. Gains classified as income are going to be reported on Schedule 1 if you receive them as an employee. As we mentioned earlier, as of 2025, the digital asset platform on which you bought or sold cryptocurrencies may provide you with a Form 1099-DA that's going to report your cryptocurrency transactions. As Michelle has mentioned, Fidelity Digital Assets will provide a 1099-DA for Fidelity crypto customers as applicable. Your exchange may also provide a statement that you can use to prepare your tax return if you bought or traded through their platform. And here again, Fidelity Digital Assets will do this for Fidelity crypto customers as well. In this case, it's called a gain-loss summary. Now, the gain-loss summary from Fidelity Crypto, from Fidelity Digital Assets, does not go to the Internal Revenue Service. The gain-loss summary is really only to help customers get their personal books in order for any reporting that they might have to do themselves to the IRS. And you can find those applicable forms, by the way, either on Fidelity's app or on Fidelity's website. They're listed with all of your documents there, relatively, or actually I should say very easy to find there. Anything else you would say about the gain-loss summary? Anything else I left out?
Yeah, it's just an informational, so it gives you the ability to see all of the information right there in addition to your 1099-DA, but it does come in a CSV format, so it is easier for you to be able to upload it maybe to your accountant or to some tax preparation software you might be using.
Do I get a gain-loss summary if I didn't sell anything last year?
No, it's only if you sold.
So again, if I'm a long-term holder,
then you're not going to see a 1099-DA or a gain-loss summary from us.
Got it. Okay. I want to talk about crypto IRAs. There's a lot of questions that people have about tax implications for that. And as of this year, again, Fidelity Crypto, as offered by Fidelity Digital Assets, does in fact have the opportunity for folks to invest in those account types. What do people need to know about IRAs and crypto taxes?
Yeah, so there's not a lot of difference. An IRA, you're not taxed on the buys and sells that you do within the IRA. So you're not going to be, just because it's crypto, it's going to follow the same sort of rules. The IRAs are taxed when you distribute out of them. And then there's also reporting that happens when you contribute to them. So those things will still happen. Although our crypto IRA, we do in sister with our brokerage side. So your brokerage IRA is where you're going to make your contributions and where you're going to take your distributions for. So on the crypto side, you will possibly get a 5498, which is the form that reports contributions and the December 31st market value.
Okay.
And if you had a December 31st market value, we will create that 5498 for you. And if you are in a rollover or a traditional IRA, and you're 73 this year or later, we're going to also give you some RMD information on that 5498.
RMD, required minimum distribution.
Yes.
So many letters, so many numbers. Okay, sorry, I interrupted.
That's okay. And the forms are actually out there for the 5498 for our customers. So if they had a December 31st balance, it is already out there ready for them.
But again, any exchanges or swaps or purchases or sales inside of an IRA, no tax obligation due as long as everything stays inside the IRA.
That's correct.
Got it. I want to talk a little bit about ways, Michelle, that we might be able potentially to deduct crypto losses. Important to note that Fidelity doesn't give tax advice here, but we can make an attempt to answer Armand's question, for example. What portion of our taxable income can we offset with loss reporting? So this is kind of going to be, or very much will be, the inverse of what we talked about a moment ago. So let's talk about ways in which you might have a deductible loss. And the first most obvious one is you bought some crypto, it declined in value, and you sold at a loss.
Yeah, and I think it's important to note this is not going to be losses that you might see in your retirement account, in your crypto IRA.
Correct.
That is not going to apply here. But if you have an individual or joint account with us and you sold at a loss, then you will be able to reduce any gains that you've also incurred for the year from that. And if you have $3,000 additional losses, you could reduce your income by that as well.
And so the simple example is, I bought $1,000 worth of Litecoin this year and it decreased in value. I sold it for $800. That's a $200 capital loss that I probably should go ahead and let the IRS be aware of.
Yeah. Like I said, you could potentially reduce your other income by that if you didn't have gains to offset.
And if the numbers are much bigger, so I have a $50,000 position in Litecoin that I sold for $40,000, that's a $10,000 capital loss, but I can only take $3,000. So walk me through what I can do with that $10,000 loss.
$3,000 a year is the most you're allowed to reduce your ordinary income by. Now, that's not to say if you have other gains that you couldn't offset those gains for that year. But if you don't have the gains to offset, then $3,000 is the max you can reduce your income by for that current year, but you can carry the rest of it forward.
What happens if I exchanged one cryptocurrency for another and took a loss there?
Same thing. It doesn't matter if it's an exchange or if it's a sell for cash. It's still the same event, same sort of event. You're selling the coin that you originally held at a loss, and you can deduct that, assuming you're not over the $3,000.
Got it. And I'm going to guess the same thing is true. Again, it's the inverse of everything we talked about a minute ago. If I bought a good or paid for a service with cryptocurrency for which I had a loss,
again,
I get that too.
Same thing.
What if I sent crypto to somebody else and that crypto depreciated?
So when you're gifting, by sending it to somebody else, you're gifting it to them. The basis of the coin that you're gifting them stays with it. So that will not be recognized by you. You're not going to be able to take any deduction for that.
Because I gifted it?
Because you gifted it, but they will potentially have a loss if they were to immediately sell it because, they now have the basis that you sent them.
Got it. We have a handful of other ways to potentially reduce your crypto tax burden. First, if you paid fees on your crypto purchase, you may be able to add those fees to your cost basis. Also, if you donated crypto, you might be able to take a deduction based on the fair market value of your crypto at the time of that donation. Also, if you gifted crypto, gifting, as we talked about, is not generally taxable. Unless the value of the crypto, I should say, exceeds this year's gift tax exclusions. Another way to potentially lower your taxable burden is if you hold your investments for at least 1 year before selling. We talked about that before, but worth repeating again. Long-term capital gains are taxed at lower rates than short-term capital gains. But as we've also noted many times, Michelle, everyone's tax situation is different. There is no one-size-fits-all answer here. So we would suggest that you talk to a tax advisor about any specific questions. Oh, and another reminder, we do get this question from time to time. What happens if my crypto was stolen? What happens if my crypto was lost? What if I self-custody and I lost my cold wallet?
Yeah.
According to current law, those are unfortunately not tax deductible events. That's bad news on every possible front if, in fact, you self-custody and you lose your wallet. One other strategy worth discussing here before we head to live Q&A is tax loss harvesting, which we sort of started to talk about, but we'll talk more about it now. Lou quite blatantly says, please cover tax loss harvesting for crypto. And again, this really fits nicely with our conversation on strategies to potentially help reduce cryptocurrency tax burdens. So to quickly define tax loss harvesting in the crypto context, that really just means offsetting your crypto losses against crypto gains, or as Michelle suggested, other capital gains to help reduce your overall tax bill. So for example, if you bought $10,000 each of, let's say, Bitcoin and Ethereum, at the end of the year, hypothetically, your Bitcoin is worth 12 grand and your ETH is worth $7,500. If you sold both at that moment, your Bitcoin would have a $2,000 capital gain, your ETH would have a $2,500 capital loss, and you would net out with potentially a $500 capital loss. But one other strategy, and that, by the way, that's a very, very high level way to answer that question. There's a lot of nuance involved. And I want you to talk a little bit, please, about tax lot selections, because you can be really strategic figuring out what you want to sell in order to try to maximize potentially your minimize how much tax you owe or maximize how much you don't owe. I said that all wrong. You've got a slide that'll say it much cleaner than I did.
Yeah, so you do have the ability through our Fidelity.com application and the web services to be able to go in and tell us when you're doing your sale. So we have in that slide, we show you what the sale page looks like. You can go in and you can choose that specific lot indicator on there, and then it'll pull up the screen next to it, which will list all of your lots. You'll see where you're sitting with each position so that you can identify specifically which lots you're targeting. So maybe I have already had a loss earlier in the year and I want to use that loss to be able to offset some of the gains I'm sitting on in my crypto. So I will sell the lots that have a higher gain to be able to utilize that loss, or vice versa. You've had a gain somewhere else and you've got some losses in your crypto. You can identify those specific lots that you purchased or transferred in and reduce those when you're selling.
What happens if I'm a Fidelity crypto customer and I sell, but I don't pick which lot? What gets sold?
It goes FIFO, so first in, first out. So whatever you bought or transferred in will be depleted first.
But as you're pointing out, that might not always be to your strategic tax advantage. So you want to go in and pick your tax lots if you're so inclined.
Correct.
Michelle, thank you so much for taking time to be with us today.
Thank you for having me.
And thank you for everybody who took time to engage with us, sending in questions when you registered or during the live conversation. Really appreciate it. One final reminder to register for our next live stream using the link on your screen. Drop your questions while you're registering. Come to the show live and ask your questions. We'll take them just as we did here. And we really thank you for your engagement. It really helps make the show that much better when we know that we're answering your real questions live. Don't forget also, you can always check out other on-demand episodes at fidelity.com/covering crypto livestream. That's our library of all on-demand episodes, where this episode will be shortly as well, along with all of our other ones. On behalf of everyone behind the scenes here, thank you so much for taking time to be with us today, and we hope to see you soon.